Good morning and welcome to this week's show. As usual, I'm going to go or sort of run through the news from this week. It's been sort of quite a quiet world in sort of investment trust land this week, but I actually managed to find a few things to talk about. There's a bit of a theme there. And then I'm going to bring on this week's special guest, which is Ian Franco-Francis, manager of CQS New City High Yield. We've had sort of Franco on before, but I think it's been a good couple of years. So it's great to have him back to give us an update. Anyway, as I said, it's been sort of quite a quiet week. But there are a few things to talk about. There's a bit of a theme here, in as much as so the market's been quite challenging, certainly the last couple of years for certain types of investments, particularly sort of some of the alternatives. And we're sort of starting to see some action on sort of some of these, or particularly this week, there's been a few things that have sort of come through on that. So the first thing that I want to talk about is JPMorgan Core Real Assets, which has sort of now announced its intention to wind up. The second is sort of Weiss Career Opportunity, which has announced a strategic review. And we'll sort of see what emerges from this, but I think that there's a high probability that this could wind up as well, so we can talk about that. Third is Atrato Onsite Energy, which announced this morning that it sold its entire portfolio. And obviously this wasn't a surprise. We know that it was attempting to do this. And of course, that now looks like it's going to wind up, and that's certainly the plan. On a sort of flip to that, I wanted to talk about something called HH2E, which is a sort of German hydrogen company. It's developing a couple of sort of German hydrogen projects, or sort of green hydrogen projects, and it looks like that's going to administration. Why does that matter to investment companies? Well, sort of some of them have got some exposure to that, so we're going to talk about that. And then a bit of good news. Want to talk about sort of supermarket income REIT. That sort of changed the fate or basis of its fees, and that's going to be good for shareholders. So let's talk about Jara. So Jara is now 5 years old. It was launched in sort of September 2019, and it had sort of one of the features built in was it would get 5 yearly continuation votes, and it's had the first one of these in the beginning of September. As I say, when it launched, it raised about 150 million quid, which was, or just shy of that, and that was its target. And obviously the hope was it would grow and that you would get obviously additional efficiencies. It sort of certainly seemed like a good thing at the time because there was expectation that inflation could go up. Obviously, we didn't know what was going to happen with COVID when it was launched, but actually that sort of became a thing. And then this looked like it had a sort of lot of potential. And sort of core real assets were defined as sort of assets with cash flows that are stable and forecastable for long periods of time, typically 5 years or more, with a sort of low margin of error. And this had a sort of focus on real estate, transport assets, a lot of infrastructure, and some sort of cash as well. And the idea it was either going to be in sort of existing JPMorgan funds exposed to these things, or some sort of specific managed accounts. And it was very popular at the time. It was, the most popular IPO on Interactive Investor, that sort of stat that I had there, since Smithson. Now, as I say, it got to its sort of 5 yearly continuation vote on the 3rd of September, and it did not pass. And we'll explore the reasons for that in a minute. But board is engaged with the sort of big shareholders, and basically they've concluded, and I think, the sort of scale of the fund is a sort of fact here, but they've concluded that a managed wind down is in the best interests of all shareholders. That's going to require shareholder approval. So they'll be putting some documentation together on that, and there will obviously be a vote. But as I say, size was an issue with this, and I think interest rate movements actually acted against it, didn't work out in the way that they'd sort of planned. And you can kind of see this here. Obviously, it sits in the flexible investment sector, and I've ranked this in terms of the 5-year returns. Anybody can go and do this. Obviously, you can find this in data tables on our website. But over 5 years, basically, you've got a compound annual return of about 1.4%. That's 1.4% NAV total return per annum. Actually, given the way that sort of this share price has moved, you've lost 3% per annum in sort of real terms. But obviously, there's going to be an uplift there as this is rolled out and people get hopefully closer to NAV. Manager thinks that it can basically liquidate sort of between 50 and 60% of the portfolio by the end of the sort of second quarter, say middle of next year, basically. And it thinks that it can redeem the other 40% over the following year, so by the middle of 2026. But obviously, there's no guarantee that this sort of estimated timeline is going to be achieved. It is contingent on liquidity being provided by the sort of underlying funds. And obviously, these are private funds. Now, it also says that there may be other people looking to get out, and it could be in a sort of queue for some of these redemptions. And obviously that's going to be a function of market conditions as well. And this really, given the kind of things that it's sort of or investing in, that shouldn't really be a surprise. However, it does have around sort of 50% in sort of listed real estate assets, and other sort of things that are quite easily realizable. So obviously it will crack on and sort of return those to shareholders. At the moment, it's trading on around sort of an 18% discount as of this morning. And if it can achieve sort of exits close to NAV, then there's some sort of good uplift available there. Next thing is sort of Weiss Career Opportunity. As I said, this has announced the sort of strategic review. Now, this is a really unusual fund, and it's the sort of kind of thing that's really nice to have in the closed-end space, because nobody else is doing something like this. Not certainly that small shareholders can get access to, but it's quite a sort of an unusual structure. So this invests in South Korean preference shares. And they are sort of a bit different to the kind of preference shares that you tend to get elsewhere in the world. So they are effectively non-voting common shares. And what you get is, the sort of common share dividend plus an additional fixed amount. So you're actually getting a higher return. But obviously you don't have the vote. Despite getting these high returns, these actually tend to trade at a discount to the common equity. So you end up with higher dividend yields and lower sort of PE ratios. So you end up with quite an attractive way to get exposure to Korea. I mean, that's the theory anyway. So what's actually happened? Well, I'll sort of look at the performance in a minute, and I think that's a big part of the problem. But this was launched in 2013, and the manager has basically said to the board that it believes the opportunity set and strategy of the fund continuing in its current form is less attractive than it has been in the past, including at the company's inception in 2013. And probably more importantly, it does not think this change in circumstances is likely to improve in the foreseeable future. So it sounds like really it sort of wants to throw in the towel. It's important to notice that, or sort of note, the manager hasn't given notice, and it says it remains committed to fulfilling its obligation under the investment manager agreement in full. So it's quite happy to carry on doing what it's doing, but it doesn't see much of an opportunity there. Not surprisingly, the board has put out a strategic review, and obviously they're going to look at options. It says it welcomes the views of all shareholders. So if you are invested in this and you've got a view, then obviously get in touch. And they suggest that you sort of do that via the broker. Obviously, this provides regular realization opportunities. The next one is sort of due by the end of May 2025, or sort of no later than. And they said they're going to do that still. They already remain committed to doing it. And they also say, while the review is being conducted, until they've obviously got the conclusions, existing investment policy and strategy will remain in place. But I think if you sort of look at it here, it's the sort of bottom line. And once again, over, let's say, take the 5-year period, it's provided you, with 4.9% compound per annum over, 3 years. It's sort of lost you, 9.8 compound per annum. So it's, I think been a more volatile ride, and the returns have not been, as much as they expected. And this is really why, as I say, the manager is probably throwing in the towel. I think the other thing is, certain US managers say they now find it harder to talk to, investors in London. Obviously, investors in London expect higher disclosure than, sort of American managers typically used to. And I think they're finding that a challenge as well. So you can see in this chart here, last 3 years have been tougher. I mean, had, a sort of great recovery post-COVID, et cetera, but last 3 years have been very difficult. And this is where we've sort of ended up. Next one that I want to talk about was Atrato, Onsite Energy, just continuing this theme. We knew they were attempting to sort of sell the portfolio, and they've done this, and they've basically sold it to a JV between Brookfield and sort of Rain Apollo. As expected, headline price basically 219 million pounds in cash thereabouts, pretty close to sort of last valuation, which is about 224 million. So you say you're getting out at a sort of 8.1% discount to the 31st of March NAV. This actually completed on the 7th of November. No real surprise. As I say, shareholders approved the investment policy change that was going to allow this at the end of October. So they are now looking to wind this up, and you're going to see that coming through. The only sort of rinky-dink with this that's perhaps a little bit different, but it doesn't actually have any impact on the NAV, is that it was expected that the sort of JV was going to take on the sort of RCF, and that's not happening now. But there's been an amendment in the sort of documentation, so basically it makes no difference to the NAV, etc. So basically as it was. And you can see sort of in this chart here, basically NAV's been pretty solid with this. This is the 1 year chart. As you say, it's largely tracked sideways. Obviously, share price is a lot more volatile, but you can sort of really see the uplift when they basically said that they were going to flog the portfolio. Next thing I want to talk about was obviously this thing called HH2E. Now, we've had sort of separate announcements from Hydrogen Capital Growth and Foresight Environmental Infrastructure in relation to this morning. HH2E was developing these sort of 2 industrial scale green hydrogen projects in Germany. And it's had sort of quite a bit of money so far, and it's, you know, a lot of this kit's quite expensive, and they've been placing orders for this equipment that they're going to need. And they needed another fundraising round to move ahead with the first project. And they couldn't find a financing partner. And basically, both sides are now saying there's material uncertainty of whether adequate financing will be achieved. And it is expected that HH2E is going to enter administration, obviously with all of the implications that has for its investors. To give you some sort of sense of this, FGen has so far put sort of 22.3 million euros in, which is 2.6% of its NAV as at the 30th of June. So not welcome, but you know, not necessarily catastrophic by any means, because of course some of that may well be recoverable. It's a bit more of a concern for HGen. They've got 11 million quid in there, 8% of its NAV at the end of September. HGen, as part of that, provided a sort of 1 million shareholder loan, which obviously is going to rank ahead of the equity, but it is subordinated to all other creditors under German law. So we'd be interested to see what comes out of that. HGen's share price, not surprising, has reacted quite negatively. When I sort of looked this morning, it was down 21% on the day, FGen down 4%. So in both cases, a bit more than the sort of implied NAV impact, but it's not really surprising. So we'll see how that rolls out. In terms of sort of good news, Supermarket Income REIT is adjusting the way that its management fee is calculated. Previously, it's been sort of a proportion of NAV, and you can kind of see the sort of table at the bottom that explains what this looked like. This is effective beginning of the next financial year, so 1st July 2025, but it's basically the same bands and fee rates. The thresholds are all the same. And you know, except the only difference is instead of it being on NAV, it's now market cap. And as this is trading on a low 20s discount, this means money saved for shareholders, you know, once that kicked in, and it's going to enhance earnings. And that is basically it. So that's all I really wanted to talk about this morning in terms of the news. Obviously, got a disclaimer here. These things are important, so if you get a chance, please read that. And if you can't read it now, then obviously pop back and read it later.